Hello, fellow expats. So here is a highly requested webinar topic, which is investments and US expat taxes. We all know we should be technically investing our money and saving up for retirement. However, it gets really tricky, as with everything else, when you are living abroad, especially as an American. So let's dive in and figure out what are the common pitfalls, so to say, when it comes to investments and US expat taxes and things that you should be aware of. Now, before I start, why am I here? Why are you listening to a webinar from us? So MyExpatTaxes is the leading US expat tax software on the market. It's a tax software made specifically for US expat taxes because, as you know, as an American living abroad, there's just not that many services that are catered for you. And that's what I found out myself as a US expat. So I'm from California, I'm now living in Austria, and essentially I had the same problem as you. I moved abroad and I realized how complex it was to file taxes back home, the fact that I even have to file taxes back home, and then from then on, how hard it is to invest as an American living abroad. So we'll dive into those topics today, keeping in mind, we don't provide investment advice. We are here to help you with your US expat taxes. So I can definitely tell you what to watch out for, what to be aware of, but we are not here to give you any investment advice about what you should be putting your money into. We can only tell you what happens after you put your money into certain things. So with that being said, the topics we'll cover today is US investments, US IRAs, foreign investments, foreign retirement accounts, and of course some basic tax 101, just so you can walk away knowing this is what I may or may not should be looking at in terms of investments and how they'll actually be reported on my US tax return. So I think probably the easiest relative as always, but probably one of the more common investments that Americans abroad make are just simply investments in their US brokerages. So you still invest money back home. Now, I think the main expat issue here is the fact that it's very difficult to invest in a US brokerage if you don't live in the US. I know a lot of Americans will probably use a different address of a trusted person back home or their previous address. I'm not here to tell you if that's right or correct. I'm just telling you that that's what a lot of people do. So essentially, if you are investing in a US-based brokerage, it's pretty simple on your US tax return because obviously you're investing in US regulated markets. So what you'll end up getting is a Form 1099 or a K-1 in the next year, and then you'll use that to report the income onto your US tax return. And what you'll normally do is, report interest, dividends, capital gains, etc. And you might even be eligible for preferred tax rates, such as the qualified dividends and long-term capital gains tax rate, which means that this special investment income can be taxed as little as 0% to 20%. So rather than your ordinary income tax rates. Now, the tricky part is local taxation, because of course, you also have to file your taxes where you currently live. This can definitely be a lot trickier because, one, if you have tax residency in a local country, you probably have to report your worldwide income as well. So that income that you earn from the US brokerages, I would assume is probably reportable and taxable. Of course, we don't advise on local taxes at the moment, just US taxes, so take everything with a grain of salt. Now, aside from that, if you're investing now then into US mutual funds, ETFs, basically any types of pooled funds, that might even cause even more complex reporting locally. So again, while US investments and US brokerages, if you can even access them, are fairly simple for your US tax return, always be aware of how they may be taxed locally. Now, the next big kind of investment pot is individual retirement accounts, so IRAs. As a US expat, you can still invest in your IRA, you can still contribute to it. So the main expat issue here is pretty much to do with what your limits on contributions are. So I will get into that a bit more later, but let's talk about the different types of IRAs. So we do have a whole YouTube video on IRAs that I dig into the topic very deeply. But for now, just know that generally there's a traditional IRA. This is with pre-tax contributions. What that means is today you get a tax deduction. Later on, you have to pay tax on your distribution, or you have to at least report it and it may be taxable. Now, the second type of IRA is a Roth IRA. What that means is you put in post-tax contributions. So today, you get nothing. There is no tax deduction. Later on, you may be able to pull out qualified distributions completely tax-free, including earnings. So those are the two types of IRAs. Now, aside from determining which IRA you want to contribute to, you have to be mindful of your contribution limits. So essentially, the IRA contribution limits are the lower of what you're allowed to contribute based on your taxable compensation or your income level, and I'll get to that, or the regular maximum annual allowance, which is between $6,000 to $7,000 based on your age. Tricky part for expats. If you are using the foreign earned income exclusion, you might not have enough taxable compensation to contribute. Say you have $50,000 in foreign wages, then you exclude all of that with the foreign earned income exclusion. That means you have zero taxable compensation because your wages are no longer taxable. So that would mean you cannot contribute to either a traditional or a Roth IRA. Now, another situation to be mindful of is if you're married filing separately, if you make over $10,000 in income, even after using the foreign earned income exclusion, right? If you make $10,000 in income, you cannot contribute to a Roth IRA because it's deemed that you have too much income to contribute. So be very mindful of your contribution limits as an expat. As always, there are ways around it, right? So I don't dive into it, but essentially if you're using MyExpatTaxes, you're in the professional or the premium tier working with a tax professional and you want to contribute to an IRA, we can definitely look to see if we can use foreign tax credit instead, or if we can help you try to do a backdoor Roth IRA contribution. So there's definitely ways to contribute. You just have to be aware that it's not as straightforward as it normally is for those living in America. Now, obviously, for your local taxation, that's where it gets even trickier because it may not be tax-free. In the situation of, your contributions to a traditional IRA may not be tax deductible, and your distributions from a Roth IRA may not be tax-free when they come out locally. So just keep that in mind. There's always differences between the US and your local country. There are a few countries where they will adhere to IRA's tax treatment in the US locally. So, those are options. However, you do need to make sure that you work with a tax professional or a financial, advisor that actually knows something about taxes in order to make the right decisions. So the next topic is foreign investments. So you decide, I don't want to invest in the US. I want to invest in my local country. I want to invest abroad. Main expat tax issue, PFIF. You will learn this word by heart, PFIF. Passive Foreign Investment Company, PFIF. It's terrible. It's not that terrible. With proper planning, it's actually fine. But I think generally everyone's first reaction to hearing the word PFIF is fear. There's no need for that, but it is a little bit more complex. So it's essentially Form 8621. And what that means is, if you have a certain type of investment, you may have to go through more rigorous reporting for that investment. The next slide will dive deep into that. We'll backtrack a little bit. Generally, if you have foreign investments, assuming they're not PFIFs, right, and they're just, interest or regular dividends or investments in active companies, not passive companies, things to know. All income is taxable. So even if you're investing in a tax-free vehicle abroad, so say if you're in Canada, you're investing in a tax-free savings account, guess what? It's not tax-free in the US, it's taxable. So keep that in mind. Tax-free locally definitely does not equal tax-free in the US for the most case. Now, how is that foreign investment taxed? So interest tax normally like US interest, which is ordinary income tax rates. If it's dividends, even if foreign dividends, you can claim them as qualified dividends if they're eligible to be qualified. Capital gains, again, if they're long-term capital gains, they may still be eligible for the preferred long-term capital gains tax rates that I talked about before. And if you have foreign mutual funds, that's the next slide, PFIFs. Local taxation, it's generally not an issue because you're, investing locally. So you're probably adhering to some type of investment scheme that's regulated by your local country. Again, generally. So is it a PFIF? I think is always the burning question. First thing to go through is it regulated in the US? Are you investing in things that are regulated on the US market? Are you going to get a 1099 US tax form to declare that income, meaning that that financial institution has declared the income to the IRS and they give you a copy for your record for you to put onto your US tax return? If the answer is yes, that it is regulated in the US, that you get a 1099 form, it's not a PFIF. Now, the second part is, are you investing in a pooled fund? So single stock holdings, say you invest in Apple, in Google, BMW, etc., or you invest obviously in a foreign company, but it's a company that has employees and they sell a service, they're actively earning income. It's not, a passive type of holding, which is mostly, say, a mutual fund or an ETF, basically an entity that is set up just to collect passive income or mostly passive income. Then, single stocks, generally not pooled funds, generally reported normally, dividends are reported normally, capital gains are reported normally. If it is a pooled fund, right, and there is a more complex text lying underneath, I don't get into it, but it's basically called the asset and the income test. Again, I don't dive too much into it. If it is a pooled fund and it's basically a mutual fund, an ETF, etc., that is foreign, that is not regulated by the US market, PFIF. And if you have a PFIF, then you will have to file Form 8621 in most situations. So, is it that terrible to report a PFIF? Generally, I don't think it is, right? With proper planning, if your investment pays off, you have a high return, then it's probably worth the extra hassle of reporting it as a PFIF and the additional cost to reporting it as a PFIF. Because I think probably the part that hurts the most is how much these forms can cost to prepare. MyExpatTaxes, we generally prepare them very affordably. So, anywhere between 49 euros to 99 euros at the current moment versus other firms which might be charging up to, 250, etc. for one form. Anyways, if you do report it, these are things to note. There are 3 types of elections you can make, and they're very important to determine how your foreign mutual fund or generally foreign pooled funds will be taxed. The most preferred taxation rate comes from the qualified electing fund, QEF. This will basically split your income into 2 different buckets. So you have ordinary earnings and then you have long-term capital gains, which can be taxed at long-term capital gains tax rates. You cannot make the decision to really elect any PFIF as a QEF. The financial institution you invest in should tell you if your investments qualify as a QEF, and if so, you get some extra statements, and then you can make the election. It is a first-year election requirement, which means that you have to make the election when you buy that fund. So when you initially purchase that fund, you have to file Form 8621 in that initial year on your tax return. If you wait longer, then it goes into the default election at the bottom. Now, the next election, which is probably my preferred one, just because 99% of foreign mutual funds are not QEF eligible, is mark-to-market, M2M, which basically will calculate an unrealized gain. So every single year, what you will have is you will calculate what's the fair market value of that holding at the end of the tax year, what is your basis in that holding, and any gain on that will be taxed as ordinary income. Generally, I don't see people actually paying extra taxes on this unless you obviously have a huge appreciation in your holdings. Now, this is more likely to be used on expat tax returns because any PFIF can be declared as a mark-to-market fund. But you do have to make this election again in the first year. So if you get a fund, make sure you file the 8621 immediately in that year and make the mark-to-market election. If you go through MyExpatTaxes, we'll pretty much automatically always do this on, any fund if we see that it's eligible for mark-to-market or if it's even eligible for QEF. Now, if you do not make any election, if you do not report your PFIFs in the initial year that they are purchased, then what happens is when you do start reporting them, they fall into the default election, section 1291. And basically, this is not fun because what it will do is it calculates an excess distribution. In short, what it does is it looks at your past 3 years of distributions, takes the average of that, and if you get a distribution which is 25% more of that average, that will be taxed at the highest income rate available in that tax year, so aka 37% in 2022, and then there may be interest on top of it. So you definitely can end up seeing tax if you do not make a proper election in time. Obviously, if you don't have distributions, there's no tax. It's only on excess distributions. So again, if you don't make a first year election, even if they're eligible for it, you'll have to immediately go into this default election. You can always kind of make this election late for mark-to-mark or qualified electing fund. However, it's a bit of a process and you'll probably see tax come out of it. Again, I generally think that PFIFs are fine, right? You will have to pay more in reporting them. You may get some additional tax. However, if you get a high enough return, don't shy away from foreign investments, right? It's a little more complex on a US tax return. However, it's not a general big no-no. So let's move to foreign retirement accounts because obviously we all have one. So main expat issues is that contributions might be taxable already. So meaning if your employer or the government contributes to a certain retirement fund of yours, that contribution may be reportable as wages or compensation on your current year tax return. And if you get a distribution, most of the time, that's also taxable. In a very rare case, I think really only with one country, distributions are not taxable. However, 99% of the time they are taxable from foreign retirement accounts. Now, the other expat issue is you might have a foreign trust reporting requirement, which is Form 3520, 3520A. I get into that in a little bit. However, essentially, keeping in mind, backtracking, retirement accounts abroad are okay. You have to be mindful again. If someone's contributing to it, aside from you, those contributions may be taxable in that current year. If you're getting distributions, you will have to report those distributions on your US tax return. 99% of the time, they are taxable in the US because of the savings clause in every tax treaty. Now, if you do have to report distributions, you cannot use the foreign earned income exclusion, so you'll have to use the foreign tax credit, meaning if you pay taxes abroad on your distributions, you'll claim those taxes on your US tax return. So that's, the general retirement account. Now we get into the foreign trust bit. So most standard employer pension schemes are fine. There's this amazing revenue procedure, 2017, you can Google it, and it, in short, just says, if you have a standard employer pension, right? So it's made and set up for retirement benefits, the contributions and or the income is, tax advantageous in the case of it's deferred or taxed later at taxed at lower rates, and you adhere to a couple other conditions, it is not considered a foreign trust in terms of this reporting requirement. If you have a private pension, this is where you may fall into this reporting requirement. And that form, again, it's a complex one. I think the part that hurts the most is how expensive the form can be to prepare by most tax firms. And if you don't file it and you need to, there is a $10,000 penalty, both on 3520 and 3520A. They're two separate forms. I definitely see the IRS handing out a lot of bills for this form, so it is nothing to joke about. So to say, government pensions, so Social Security schemes, those are generally exempt from this foreign trust reporting requirement. Local taxation issues, again, generally none because you are investing in a pension scheme that is, adhering and regulated by the local country. All right, so with all that in mind about foreign investments, US investments, do you even have to file a US tax return? Well, it depends on, are you a US citizen? Are you a US green card holder? And if so, is your worldwide income over those filing thresholds you see on the screen? So keeping in mind that self-employed has a lot lower of a filing requirement because if you have $400 in self-employment net profit, you still have to file a tax return. But in general, you can adhere to the filing thresholds on the screen. Yes, the one for married filing separate is extremely low at $5. So if you get $5 of interest, well, technically over $5 of interest, then you need to file a US tax return. Now, you may still want to file to get certain refunds like the stimulus payments or the additional child tax credit refund. If, your age, if you're older than 65, or if you have a dependent child with unearned income, there's different filing thresholds as well. So this is just the general filing thresholds. Now, if you're thinking, I have not been filing my US taxes, I'm super behind on filing them, what do I do? There's always a program to catch you up. It's called the Streamline Foreign Offshore Procedure, which is an amnesty program. And what you can basically do is you can file 3 back years of taxes. So that is now basically back to 2019, and then 6 back years of FBARs. And if you do this, then obviously it's a lot of paperwork, but you're all caught up, even if you haven't filed for 10, 20 years. And a lot of folks will actually get refunds because of the stimulus payments and the additional child tax credits. Now, I don't go into it too deep in this webinar. However, generally filing taxes is not all bad. There are many cases, especially if you have US children abroad, that you will be getting a refund instead of paying any taxes. And one thing to note is if you are streamlining, you will have to paper mail those prior year returns because the IRS does not allow you to e-file them. However, MyExpatTaxes, we will gladly e-file your current year return because we know how efficient e-filing is, and that's why we prioritize e-filing above all else when we do our taxes for our clients. Now, of course, keep in mind if you're using other types of tax softwares that are not necessarily catered to American expats, you'll probably get stuck with paper mailing everything, even your current year tax return, and they probably don't even have support for the FBARs. So just be aware of the services you use because as an American abroad, it is a little bit more complex, and that's why we created MyExpatTaxes, so it's specifically for your case. Now, if you are filing annually, you don't have to worry about the streamlined procedure, but you do need to keep in mind the filing deadlines. So filing and payment deadlines are a little bit different as an expat. If you have taxes due, it's always due around April. This year was April 18th, but generally it's April 15th. And if you have to file taxes as an expat, those are normally due in June. Just keep in mind, if you have to pay something, pay it by April, aka file and pay by April. And if you have to file a tax return, but you're not expecting to owe any taxes, you can wait until the June deadline. You can always file for an extension, especially through MyExpatTaxes. You can do that very easily to get an extension until October. And then obviously if you need further extensions, we'll inform everyone at that time how to get the next extension till December 15th. Normally I would recommend you don't wait until December 15th to file your US tax return. However, it is a possibility. And if you have back taxes, obviously to file that as soon as possible, because if you do have any type of taxes owed, penalties and interest is accruing every single day. So that was a lot of info about foreign investments, and I'm sure you will have a lot of questions, right? So please join our Facebook group. We are here to help you through all those questions. You can really just post any questions you have, and if the community can't help answer your questions, one of our tax experts will jump in to answer your question for you. It's a really great way to get in touch with us and also just, see that other Americans around also have the same problems as you, even if they're living in a different country. And you can also stay, tuned for the live Q&A afterwards. I hope you enjoyed this webinar. I hope you learned a little bit more about investing as a US expat. It's definitely not as easy and straightforward as if you were living in America. However, it's very doable, I would say. So that's something to walk away with, is that US taxes is not just about filing a tax return. It is actually a tool that you can use to help your financial situation, to help determine what can you invest in, how do you make sure your investments are taxed at a lower rate, how do you make sure that you file a tax return in a way that allows you to contribute to a US IRA, how do you make sure that you get into foreign retirement accounts in a way that doesn't impact your US tax return, et cetera, et cetera. So definitely something to think about. I know investments is kind of the next step. Everyone just wants to file initially their taxes. But if you're there, if you're thinking about investing, please look into it. Don't be afraid of it as a US expat. Like I said, complex, very doable. In MyExpatTaxes, we're always here with you along the way to help you through the tough parts of tax reporting, right? So hope you enjoyed and looking forward to your questions.